trillions of dollars. That is the sheer amount of wealth currently chasing a single technology, artificial intelligence. From Wall Street trading floors to the glass towers of Silicon Valley, executives, investors, and world leaders are making a massive gamble. Stock market indices break record after record, while brand new AI startups achieve multi-billion-dollar valuations virtually overnight. Tech giants insist that this time is different, claiming AI will rewrite the rules of human productivity and civilization. But if you look closely at history, this exact moment feels disturbingly familiar. 25 years ago, in 1999, the world witnessed the exact same gold rush. Back then, the magic word wasn't AI, it was the internet. And in March of 2000, $5 trillion of market value evaporated almost overnight. Today, as capital floods into data centers and microchips, we have to ask a dangerous question. Are we standing on the precipice of the largest financial bubble in human history? To understand where we are going, we first have to understand where we have been. Between 1995 and 2000, the arrival of the World Wide Web promised to revolutionize commerce, communication, and daily life. Investors, blinded by the fear of missing out, threw endless money at any company that added .com to its name. Stock valuations skyrocketed for companies like Pets.com, Webvan, and WorldCom, businesses with zero path to profitability, unsustainable burn rates, and no viable business models. At the exact same time, telecom companies believed that internet traffic would grow exponentially forever. To prepare for this golden age, they borrowed hundreds of billions of dollars to lay millions of miles of fiber optic cables beneath the earth. But human adoption could not keep up with financial speculation. In March 2000, reality finally caught up. Investors realized these hyped companies were losing millions every quarter. The Nasdaq crashed by nearly 80%, wiping out trillions in wealth, triggering mass layoffs, and causing hundreds of tech firms to go bankrupt. Up to 85% of those expensive fiber optic cables sat unused under the ground, buried as useless dark fiber. The internet was indeed the future, but the financial speculation had outpaced reality by decades. Every financial bubble has its central figurehead, the company that supplies the picks and shovels for the gold rush. In the 1990s, that central figure was Cisco Systems. Cisco built the routers and networking hardware necessary to power the early internet. Investors believed that no matter which .com startup failed, Cisco would always win because everyone needed their hardware. By the year 2000, Cisco briefly became the most valuable company on the planet. Fast forward to today, and that exact role is being played by Nvidia. Once a specialized designer of graphics cards for PC video games, Nvidia has suddenly transformed into the backbone of the global economy. Its graphic processing units, or GPUs, are the essential engines required to train and run complex generative AI models. Whether it is OpenAI, Microsoft, Google, or Meta, every tech giant is locked in a desperate bidding war to buy tens of thousands of Nvidia's flagship chips. Within a span of just 2 years, Nvidia's valuation exploded past $3 trillion, turning its chief executive, Jensen Huang, into the kingmaker of modern technology. Meanwhile, figures like OpenAI's Sam Altman are floating plans to raise up to $7 trillion just to construct chip manufacturing plants and power infrastructure. Once again, Wall Street believes that the company selling the infrastructure cannot lose. But just as Cisco learned in 2000, infrastructure suppliers are only as strong as the customers paying for their hardware. To understand why the current AI boom is beginning to resemble 1999, we need to follow the money and examine 4 critical financial realities. First, consider the astronomical capital expenditure. Big tech firms, Microsoft, Alphabet, Amazon, and Meta, are collectively spending well over $200 billion a year solely on AI infrastructure. They are building sprawling server farms, purchasing massive fleets of specialized chips, and securing energy contracts across the globe. The scale of spending is unprecedented in corporate history. Second, look at the crippling debt and energy demands tied to these data centers. AI models do not run on magic. They run on electricity and physical hardware. The power requirements for next-generation data centers are so massive that tech giants are signing deals to restart defunct nuclear power plants and build private energy grids. To fund this rapid expansion, tech companies, private equity firms, and utility partners are taking on massive loans. A dangerous web of corporate debt is quietly accumulating beneath the surface of the AI boom. Third, we face the alarming disconnect between spending and actual revenue. Venture capital firm Sequoia Capital highlighted this problem in an eye-opening analysis known as the $600 billion AI question. According to their calculations, after accounting for hardware costs, data center maintenance, and power consumption, the AI industry needs to generate $600 billion in annual revenue just to pay for the infrastructure being built today. But what is the actual reality? Today, the entire generative AI market, including ChatGPT subscriptions, enterprise tools, and image generators, produces an estimated $20 to $30 billion in total annual revenue. That leaves a staggering revenue gap of over $500 billion. Finally, examine the overvaluation of AI startups. Venture capitalists are once again pouring billions into early-stage AI startups with virtually no path to profitability. Companies with under $1 million in annual recurring revenue are receiving valuations in the billions simply because they use the word AI in their pitch decks. Furthermore, the operational cost of serving AI prompts is extraordinarily high. Every time a user asks a large language model a complex query, it consumes expensive computing power and electricity. Many AI companies are actually losing money on every single user interaction, subsidizing their growth with venture capital cash. They are selling products below cost, hoping that scale will somehow magically make the math work later. It is the exact same playbook that destroyed Pets.com and Webvan 25 years ago. So what happens when financial expectations inevitably collide with economic reality? If generative AI fails to generate massive consumer and enterprise revenues over the next few years, the entire system faces a dramatic turning point. It begins with corporate spending. When chief financial officers at Microsoft, Google, and Meta realize that their multi-billion-dollar AI investments are yielding minimal return on investment, they will be forced by shareholders to cut back on capital expenditure. The moment big tech reduces its orders for data centers and AI hardware, Nvidia's exponential growth comes to a screeching halt. Because Nvidia and a handful of tech giants currently account for a massive percentage of the S&P 500's total value, a sharp correction in tech stocks would trigger a severe market-wide crash. The fallout would quickly spread beyond Wall Street into the real economy. Private equity firms and lenders holding billions in data center debt would face widespread defaults. Utility companies that overinvested in grid expansion for AI processing would be left with stranded assets and unpayable loans. Tech companies would institute massive layoffs, cutting hundreds of thousands of jobs in a desperate bid to preserve margins. What started as a speculative technology boom would transform into a systemic credit crunch, ripple through global banking systems, and potentially trigger a broader economic recession. Yet, if history teaches us anything, it is that financial bubbles are not entirely destructive. In fact, they often serve as the chaotic birthing process for revolutionary eras. When the dot-com bubble burst in the year 2000, it wiped out trillions of dollars in paper wealth and destroyed thousands of speculative companies. But the physical infrastructure built during that manic period remained in place. Thousands of miles of dark fiber optic cables sat underground, waiting. Over the following decade, as bandwidth costs dropped and hardware improved, that exact network became the foundation for the modern digital economy. Without the speculative excess of the late 1990s, the global smartphone revolution, cloud computing, and streaming platforms like Netflix and YouTube could not have developed as rapidly as they did. We may very well see the exact same legacy unfold with artificial intelligence. If the current financial bubble pops, speculative startups will vanish, over-leveraged data center operators will go bankrupt, and Wall Street will suffer immense losses. But the physical compute power, the massive data centers, the upgraded energy grids, and the advanced semiconductor manufacturing facilities will not disappear. They will remain as the physical backbone for the next generation of technological progress. Artificial intelligence is not a passing fad. It is a fundamental technology that will eventually reshape medicine, science, education, and human labor. But technology adoption rarely follows a straight line upward. The internet changed the world, but not before wiping out $5 trillion of speculative hype. AI will likely change the world too, but perhaps only after the market clears away the illusion. As we stand at this financial crossroads, the question is no longer whether artificial intelligence is real. The real question is, when the financial tide recedes, how many of today's tech giants will be revealed to be swimming naked?